Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. The S&P 500 today closed up 1.14%, the Nasdaq nearly 1%, and the Dow 1.1 as well. Let's take a look at the different sectors. Leading today were industrials, utilities, financials, and basic materials. Lagging was healthcare, communication services, and energy. The mix today doesn't really tell us much. It's not risk on, it's not risk off. It's a bit of a mix, really. Utilities are defensives, but they're leading today. And then we have communication services, which is a risk on sector, but it's lagging. So it's a bit of a weird mix, but that makes sense because we had Netflix earnings coming out. And so the market was a little bit timid ahead of Netflix earnings. But what do you know? They did very well. Netflix stock soars as subscriber growth tops expectations. The company added 2.41 million new subscribers in the quarter, beating its own forecast of 1 million. Now, Goldman also did well, which is to be expected because of the high interest rates. Banks really do well. They print money in this type of environment. Now let's take a look at the stock market map, and we do have a bit of a mix today, right? Communication services, including Google, Meta, and Netflix today, we're trading a little bit timid ahead of the Netflix earnings, and so when Netflix beats, you can expect this sector to start to really pick up pace. Semiconductors also traded very timidly today because we do have ASML and Lam Research reporting tomorrow. ASML before the market open and Lam Research after the market close. We also have Tesla tomorrow. So again, another big company that will very likely influence the sentiment and the trend for the rest of the stock market. Now let's take a look at the daily chart for the S&P 500. We opened with a massive gap up. We gapped nearly 2% at the open. Then we retraced back down to the weekly expected move, the upper weekly expected move at $369. And then we ended up closing above it. The VIX is still pretty high at 30 and it closed below the 20-day moving average, which is a bullish sign, especially after putting it that double top. Now, the VIX is still high, which may mean that the S&P 500 could overshoot the weekly expected move again this week, especially with strong earnings. So I expect that this rally still has a lot of steam left. In fact, guys, if we take a look at the HYG, the high yield bonds, the smart money, we're still looking good here. There's no bearish divergence developing. And in fact, I expect that the HYG will continue to move up and perhaps begin to stall at the $73.50 level, at which point I expect the S&P 500 to actually take out this prior high, this prior period of consolidation, and move up even higher, trading within the $380 level and perhaps even going up to $390, again, depending on what we see from company earnings. Now let's take a look at the 2-hour chart. We gapped up, we sold off, and now we're hugging the 5-period moving average on the 2-hour chart. It looks to me like, again, another bull flag. And so again, I would not be surprised at all to see the market continue to move up in the next few days, trade within this $380 level, which is going to be a significant resistance zone. Let's take a look at the triple Qs. The triple Qs actually underperformed the S&P 500, which is not what we would like to see in a risk-on move. We would like to see the triple Qs outperform the rest of the market, but we're slowly getting there, right? We do have a lot of earnings coming out, and Netflix as well as Tesla and Apple next week will without a doubt influence how well the Nasdaq and the triple Qs will do. Now we do have this beautiful double bottom right on the PPO with a bullish divergence because we made a higher low on the PPO and a lower low on the price action. We have another crossover now, and so it looks to me like the triple Qs will want to move up at least back to the neckline of $282 within the next few days. At that point, we might start to see some more choppiness before the next leg, either to the upside or to the downside, more likely, everybody, to the downside based on seasonality. Seasonality indicates that this relief rally still has some legs, perhaps for a few more days before the bout of volatility that always comes towards the back half of October, especially the last week of October tends to be one of the weakest, seasonally speaking, in midterm years. and so we might continue to see this rally rip for a few more days before consolidating and beginning to show us negative divergences, where again I expect the HYG to stall around these levels while the S&P 500 takes out these levels, making a higher high, while the HYG makes perhaps a lower high or an equal high, and that will build into a negative divergence, which would mark a top and a sell-off. We'll see if that happens or not, but that's my thesis at this point. Now, this was a pretty hefty gap to the upside. It took out this prior resistance line, this orange line. Let me highlight it for you, everybody. Look at this. We tagged it, we sold off, we tagged it, we sold off, we took it out, and then we sold off the next day. We closed right on top of it today, and I actually expect the market to continue to rally off this prior resistance line. Now, I was very tempted to take profits at the open because of that massive gap up, but I decided to actually hold all of my long positions because I expect the S&P 500 to continue to move up into that $380 level target. Now, I do post every single trade and investment that I make in real time in the trading community. It's $20 a month if you go for the annual membership, and it's the absolute best way to support me if you want to do that. And it's also the best way to track all of my trading activity in real time. Check out the link in the description box below the video for more details. Now let's take a look at the dollar index. And again, everybody, as expected, we said the dollar index will do a double top, and that's what it did. And now it continues to see weakness. We're getting close to tagging this support line. At that point, everybody, I would be more inclined to take profits and just watch the market, see what it does. Because at that point, everybody, the risk to the downside on the S&P 500 will begin to rise. Let's take a look at the 10-year yield. And again, the 10-year yield continues to form this choppy consolidation, or I should say distribution, because it clearly looks to me like an ascending wedge that is just waiting to break to the downside. We obviously have a double top formation here with a lower high on the PPO and a higher high on the price action. Again, a bearish double top structure on the 10-year yield, and as soon as the 10-year yield cools down and begins to break down, it will allow the Nasdaq to rally significantly. Let's take a look at another critical chart, the gold ETF divided by the S&P 500. This is a risk on risk off barometer, and we continue to be squarely in risk on mode. Every single time we had a bearish crossover on this ratio where money began to flow out of gold and into the S&P 500, we had nice, beautiful relief rallies. And so we continue to be in risk on mode where money managers are moving assets from safe havens into risky assets like the S&P 500 and the rest of the stock market. This is my trusty CPC put to call ratio buy and sell signal. I developed this signal, or at least this variation of this buy and sell signal myself. I spent weeks on it. And eventually we got into a point where the signal is 100% accurate in forecasting market reversals. I made a member exclusive video for our trading community on exactly how to set this signal up because it's a little bit complicated. It's not easy to set up. And so if you're interested, please check out the link in the description to join our trading community where I go through exactly how to set this signal up. Now, the way to read the signal, everybody, for a sell signal, we need to see the CPC trading below 95, and then we need to see it cross over. As the PPO crosses over, that triggers a confirmed sell signal. For a buy signal, I need to see the CPC trading above 1.1, then I need to see it cross down and simultaneously cross down on the PPO as well, and that triggers a beautiful buy signal. This buy signal marked the June low, and it marked it perfectly. And again, we were trading above 1.1, we crossed down, and the PPO crossed down at the same time, and it triggered this beautiful buy signal. Now, from this point to this point, everybody, the market was down significantly. We're talking over 20%. But if you followed this buy and sell signal, you will have outperformed the market infinitely because you would have been over 400% in the green, trading options to the downside when the sell signal triggers and to the upside when the buy signal is triggered. In fact, just in this last move to the downside, we made two 100% profit trades. This was one, this was the second one. as we rode this sell-off to the downside using a bear put spread. Now the signal continues to flash buy risk on, and in fact we're getting very close to crossing below the 95 level, at which point we've seen buying accelerate in the past. Let's take a look at another risk on risk off chart, and it's the IWM, the Russell 2000 divided by the S&P 500. And we continue to print green weeks, everybody. This is the fourth consecutive green week where we're closing above the 50-week moving average, the 20-week moving average, and the 9-week moving average. The last time this happened was back here, and we had a massive rally. Let's take a look at what we have coming up tomorrow, everybody. Wednesday, we'll have the housing figures coming out. And remember, everybody, mortgage rates are sky high, hitting records we haven't seen in over 20 years. So I expect the housing market to continue to slow down, housing starts to be weaker than expected, and building permits to plummet. We also have a lot of Fed speakers coming out tomorrow and on Thursday. More home sales figures, more Fed speakers. Friday, more Fed speakers. The most important thing to watch for this week is Tesla's earnings tomorrow, as well as ASML and Lam Research. Again, if we get a positive reaction following these earnings reports from ASML, Lam, and Tesla, I expect the S&P 500 to continue to rip to the upside, going up to the $380 resistance zone, the prior supply zone, and perhaps even overshooting that to go up to $390, an area where we had significant reactions in the past. It acted as resistance. Once we broke through it, it acted as support, and then once we broke through it, it will act as resistance once again. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow!